Hi, everyone. Today, we're going to talk about mortgage down payment requirements. There's a lot of you looking to enter the mortgage market and trying to figure out how to do that. And one of the key things you need is a down payment. So what does that all mean for you as a new entrant into the housing market? Well, what is a down payment? It's the investment in your own property. Lenders require a borrower to have some skin in the game, which is the cash amount that you contribute to the purchase of your property, and then the lender provides the rest. As an example, if you had a 10% down payment on a $100,000 property, you would pay $10,000. The lender would contribute $90,000, and you'd pay $100,000 for that property. Simple math there, but that's the gist of it. What are the actual minimum down payment requirements in Canada, though? Well, there's two different categories. First is for insured mortgages, where you get mortgage default insurance that protects the lender against the risk that you might default on your mortgage. The minimum down payment is 5% of the first $500,000 of the property value. So mortgage default insurance allows you to get into the market having only saved 5% of the property value, which is it's a good product that way. If the property is worth between 500,000 and $1 million, that portion of the value, you need at least 10%. So it's a weighted formula up to $1 million, but anything over $1 million is not eligible for mortgage default insurance. That gets into the other category, which is uninsured or otherwise called conventional mortgages, where a minimum 20% of the property value is required. A mortgages, prime mortgages with down payments of 20% or greater do not require mortgage default insurance. Regulated lenders are allowed to hold those on their balance sheet. If the down payment is less than 20%, those regulated lenders need that mortgage default insurance to be able to hold that mortgage. That's why this insurance is required. Also, if you're refinancing a mortgage with a new lender, you require a minimum down payment of 20%. You can switch your mortgage to a new lender where you only maybe change the rate on the mortgage to get a current rate, but don't change any of the terms and not have to worry about the minimum down payment. But if you're doing a refinance where you're changing substantial terms, like maybe getting an incremental amount financed or extending the amortization, the max loan to value on that is 80% for the lender, with you putting in the 20% at least on your own. B mortgages, if you don't qualify for an A or a prime mortgage, also require a minimum down payment of 20%. And throughout these conventional mortgage products, some properties, some mortgage products, some lenders may require minimum down payments that may even be higher. Say on some properties, it might be 35% as an example. So what are the eligible sources for a down payment? Lenders will look into where the down payment funds originated. It's part of their due diligence, part of their anti-money laundering obligations, and that sort of thing. So it's a regulatory requirement for them. The eligible sources include cash that you currently hold in bank or investment accounts. They'll look at your statements, make sure they know where that money came from, and hopefully they'll see that it's been in your account for some time. You can use proceeds from the sale of an existing property. If you're selling your house and buying a new one, you can take the proceeds from that sale, and that can be contributed towards your down payment. A gift from an immediate family member. That's much more common these days as younger generations are trying to enter this housing market, which is very expensive in our larger cities. A gift from an immediate family member can help them save what is often a very substantial minimum down payment. Or you can borrow equity from another property that you own. If there's built up equity in that property, you can maybe get a HELOC or some other secured funding to take out some cash from that and use it towards your down payment on a new property. Note that if the funds can't be traced, if they come from a sanctioned country or are gifted by a non-relative, the lender may not approve the mortgage. In fact, they probably won't approve the mortgage. So what are some tips for saving for a down payment for new home buyers? First, create a budget. Understand how much you need to save and how you get from here to there, how long it's going to take you, and how you put that money aside so that you can save for the down payment. And automate those savings. That way it sort of forces that a certain amount of your monthly income can be put towards it without you even having to think about it. It makes it easier. One way to do that is with a first home savings account, which is a terrific product for saving up for a down payment that allows you very good tax benefits and an ability to save money. And also there's an RSP program where you can take $35,000 out of your RSP to put towards your down payment, which can be very helpful as well. Reduce your debt. The more you're spending to pay on debt, the less you're saving. Family support, as we mentioned, a gift from family can really be a big contributor to a down payment. and then alternative programs like co-ownerships or rent-to-own type programs that help you over time accumulate the down payment that you need. Remember, homeownership starts with saving for a down payment. If you want to talk about how to do that or how to get into this crazy housing market with good mortgage financing, talk to us at Frank Mortgage. Find us online or call the number here. You can scan the QR code and book an appointment directly with one of our agents who can give you help on anything you need to know about mortgages. Thanks for watching.